When the termination is initiated by the employer must be aware of the minimum requirements that are governed under employment standards, and the legislations will vary right across the country depending on where the employee works and the employee's length of service. And this is what we call the minimum requirements that are governed under employment standards. And certainly an employer can do better than the minimum requirements if you have a company policy or if you're in a unionized environment through a collective agreements. Certainly an employer can do better than the legislative requirements. The notice that are owed under employment standards can either be provided in a form of a working notice, or if the employer does not want the employee to work their notice period, the employer must provide the employee with a lump sum which represents wages in lieu of notice. The statutory deduction requirements are different for the Canada Revenue Agency as well as Revenue Quebec. In the eyes of the Canada Revenue Agency, the CRA, wages in lieu of notice is treated as employment income. It is reported on the employee's T4 at the end of the year, and it forms part of the Box 14. These wages are considered pensionable, insurable, and taxable. Revenue Quebec, on the other hand, does not treat wages in lieu of notice as employment income. In fact, they treat it as an indemnity, and it's treated the same as a retiring allowance. And therefore, it is not pensionable, so there's no QPP deduction. It is insurable in the eyes of CRA, so insurable for EI purposes as well as QPIP, the Quebec Parental Insurance Plan. It is also considered taxable, as I mentioned earlier. So under the federal legislation, it is subject to the bonus tax method, and on the Quebec side, the monies are subject to the lump sum tax rates. In addition to the statutory deductions, employers in Quebec must include these wages in the Quebec Labor Standards Tax Levy. Severance payment is a legislative payment which is paid over and above the wages in lieu of notice requirement under employment labor standards. There are two jurisdictions in Canada which legislates severance pay: the Canada Labour Code and Ontario Employment Standards Act 2000. These are the only jurisdictions in Canada which has legislations for severance payment. That's not to say that an employer may not choose to pay severance. Certainly an employer can do better, as I mentioned earlier. An employer can pay over and above the legislative requirements. Employers with these employees in these two jurisdictions will have to review the legislative requirements and determine whether or not severance is applicable. A salary continuance basically means that the employer-employee relationship still exists even after the termination of the employee's employment. However, in order for the payment to qualify as a salary continuance or a true salary continuance in the eyes of CRA, an employer must continue to maintain an employee's registered pension plan contribution or a DPSP contribution, a deferred profit sharing plan contribution. In the eyes of CRA, the connection is still there between the employer and the employee, and so therefore the payment that an employer pays would represent employment income. A retiring allowance is basically the opposite. A retiring allowance is basically where there is no longer an employer-employee relationship. The relationship has been severed. A retiring allowance is a sum of money that is paid to an individual upon termination or after termination. Retiring allowances, as I mentioned, basically means there is no longer an employer-employee relationship. Salary continuance is employment income and subject to regular statutory deductions. A retiring allowance is not subject to CPP, EI, but it is taxable using the lump sum tax rates. Unless the employee chooses to transfer that money tax-free into an RPP or an RRSP.